First, the Fed cutting rates by a quarter point with its members divided on further action this year. Despite passionately opposing opinions both internally and externally, the markets ended mixed on the day. Did Chairman Jay Powell just thread the needle? Guy,
thread the needle. I mean, I don't know if, well, let's put it this way. I think when he opened the door to another round of quantitative, another round of, getting the balance sheet back up to where it was, to me, that was the reason why the Dow went down 170 to basically unchanged on the day. So in that regard, maybe he said what the market needed to hear. And in terms of myself, sometimes you have to be confident in your views, but there's a fine line between being confident and dogmatic. And again, I've been bearish now for a month and a half, 2 months, on the back of everything we've talked about. But when you see price action like we did on Monday, on a day where I thought the market was going to be down at least 300 Dow points, 3540 S&P handles was down 10. You have to at some point say, you know what, the market seems to want to go higher here.
Grasso.
So I think the only concerning issue was what Guy said, the balance sheet. That was concerning. But if you were in the camp where you wanted lower rates, you got it. If you were in the camp where you didn't want extended lower rates, you kind of got that too. So it was a little bit of everything for somebody. And I think the market does move higher from here.
Yeah, I mean, rates even moved higher today, which is extraordinary.
I mean, from the perspective of the equity market, I think the Fed nailed it. He did everything he needed to do. And, as cautious as you want to be, to Guy's point, if the market wants to move higher in the light of all of these things that you can create as a bear case, then the market's going to move higher. And so you look at stuff like the banks going higher today. You look at the cyclicals going higher today. Those are all very positive signs for this market. And I think it's really important that the Fed did say, hey, listen, if the data turns down, we are going to be there with very strong response. And not only that, we understand the repo market was a mess. We will increase our balance sheet if we need to. So from the perspective of equities, you got everything you wanted.
Isn't that exactly basically what he said at various other points in time, that we're going to be data dependent, we'll do whatever it takes? I mean, it's really not any different. So what is the lens through which we're viewing Chair Powell today?
Relative to the market's expectations.
Okay.
So good question. And if you think about where we were in August with the S&P significantly lower from here, and we got a hawkish cut, what did the market do? Today is a victory for a market that gets one more Fed meeting out of the way. I know it sounds insignificant, but for equity positioning overall, which in aggregate is 1.5 standard deviations below where it should be, when you've got all kinds of measures of at least positioning that I think say we're overweight bonds, I think that the market was very interesting. For the hawks out there, it's tough because he didn't talk about the need to justify another cut. There really wasn't a lot in here for people, and that's why I would lean towards more of a hawkish, even though we have these dynamics with the money markets and what that could people interpret. You have a case where I actually think that the Fed is probably more divided than people also think. I know that wasn't meaningful today, but I think as we get into the December meetings, et cetera, I think that's important. But make no mistake, and it's interesting because I hear on this desk people actually willing to throw some applause towards the Fed, and that's not something we've been getting.
Yeah, but I think you have to with the reaction today. Now, who knows what happens tomorrow? Maybe the trade war increases. But if you look at what the market is telling you today, the market is pricing in movement on trade war and a Federal Reserve that will be somewhat accommodating.
How do you short it, though? I always ask you this question. How do you short a market where you still have trade war in the back pocket? We talk about this on this desk a lot with don't fight the Fed. And then you have the trade war. And then you have a dull market. So you don't want to short a dull market. You don't want to fight the Fed. And you also have a Trump card in trade war. So it's almost impossible.
Haven't we rallied on trade, though, Steve? I get the sense that the market right now, I get the sense that actually the trade in your back pocket is something that probably 3 weeks ago, we kind of got a lot of that when they said we're getting back to the table, and it looked like it wasn't as divisive. And ultimately, none of us really expect a formative material trade deal anyway.
You just said it. You just said many of us don't expect anything formulative or substantive.
I still don't.
Okay, right. So it can't be in the market yet. So if we're all not expecting.
So you're saying you got to be long no matter what here?
I think you have to be long until you get the trade deal, and then I think that's the top in the market, because China will never be as good after the trade deal because they're giving up something by the nature of a trade deal, and the U.S. doesn't have it anymore as a variable or a tailwind. So I think you got to short the market once that trade deal comes out.
So I'd argue with that. I mean, and again, I know you talked about this last night, I'm certain, but on a day where Federal Express is probably one of the biggest down days.
Where were you last night?
I was stuck actually
Car
on the
broke down.
helix
Yeah.
of the
Car
New Jersey
broke down.
Turnpike. I put it on video, which you're more than happy to view. If you
No,
want.
but I mean, I was
save it for
concerned.
Friday night.
I
Save it
just
for
didn't know what was
Friday
going
night.
on.
That was unfortunate series.
You're not
of
that
events.
irresponsible. Let's put it that
Anyway.
way.
By the way, the roadway actually shakes when you're standing on it. It's quite actually, it's sort of alarming.
Disturbing, I would think. So you're saying it's hard to argue with being long this market?
Listen, U.S. Steel, I mean, I'm sure we'll talk about that, down 8% after earnings. Federal Express, a huge move to the downside. And you can say, Federal Express specific, they've done it to themselves. But that's somewhat of a barometer, I would think, for how the economy is doing. And again, it all comes down to what's going on with the Fed? Do they have our backs? And maybe it is that simple. I find it hard to believe once again that this all works out well, but at least for today it did.
Do you feel like we're getting the glimmers of how we set up for the fourth quarter of last year in terms of the earnings warnings that have come out so far?
Nothing's changed. I mean, in terms of the warnings, they're all again, earnings have been going, in my opinion, the wrong way. But you're getting this multiple expansion, which maybe makes sense in the light of rates being lower and the Fed having our back.
But there is this rotation that has gone on, which we saw with this quant quake we had last week, from momentum into value, rotation into cyclicals.
Quant quake.
Quant quake. It's similar in 2007. We had a quant quake as well. This is very different than that, though. This was kind of more of a rotation out of those momentum names, which were your recession names, what I'm concerned about with the utilities and all of that, and into cyclicals. So let's think about, what is that telling you? What does the market say? The market is saying, even if we have a recession, it'll likely be shallow, and the Fed will be there. And that's what this rotation is telling you. Whether you agree with it or not, that's what the market's doing.
So that is what's different about where we were from a year ago, Mel, setting up into the fourth quarter. Because I don't think the market a year ago, which was starting to get concerned on credit concerns, had any idea the Fed was going to pivot this low. So as we talked about the implied PE on a market where actually credit spreads have stayed intact, but rates have gone lower, means your PE multiple goes higher. The expectations for fourth quarter earnings are awful right now. And in fact, we went from, we basically were looking at 15 to 20% EPS growth a year ago to 2.5%, where everybody knows right now most of that is supported by buybacks and other things that are accretive to EPS. So I think it's all about positioning. And again, I would go to where equity investors were a year ago is a very confident place.
So lower rates and lower expectations this time around will prevent that kind of sell-off, even if we do hear an avalanche of pre-announcements.
I agree with that. And again, a Fed that will be there, that also talked about risk in the context of the market. That's the thing that they talked about being there for.
Isn't that aren't those huge differences between last year? Isn't that why we should not be worried about FedEx and U.S. Steel?
I think, yes, that's why you shouldn't be worried. But you should be worried because at a certain point, these things should matter. I mean, it shouldn't be as easy as the market goes higher because the Federal Reserve has our back. But I've said it, maybe it really is that simple. But at what point does that end, and at what consequence does that come with? And again, I can't believe it can't be that easy.